Hello and welcome to the 8th episode of the SLS Financial Services Podcast Shorts. My name is Brian Suitert and I am the Marketing Manager here at SLS Financial Services, and today we're going to be talking about how the new tax law affects equipment acquisition decisions. When it went into effect on January 1st, 2018, the Tax Cuts and Jobs Act of 2017 made the most significant changes to business tax law in more than 3 decades. While there are wide-ranging ramifications of these changes across all businesses, including permanently reducing the corporate tax rate from 35% to 21%, there are several aspects of the new code that specifically impact capital equipment acquisitions and finance transactions. It's important that all companies that are considering acquiring capital assets fully understand the impact of the new tax code so that they can make the right decisions and take full advantage of all the deductions available. Here are 5 equipment-related areas affected by the law and how they may impact your company. Bonus depreciation. Under the new tax law, companies can now write off as an expense the full cost of capital assets in the year in which they are acquired. This applies to both new and used equipment. This write-off, known as bonus depreciation, is a significant advantage for companies over the prior tax law, which required companies to depreciate capital assets over 3 to 5 years using the modified accelerated cost recovery system. Whether a company acquires equipment through a lease or loan, bonus depreciation should help make the transaction more affordable. It's important to note that the reduction in federal corporate tax rate from 35% to 21% reduces the impact of all tax benefits. While bonus depreciation will have an impact on companies' tax position, it is somewhat offset by the reduced tax rate. The bonus depreciation amount phases out for most equipment by 20% per year each year, beginning in 2023. Farming businesses that previously had a 7-year recovery period for depreciation will see that drop to 5 years for qualifying equipment placed in service after December 31st, 2017. Interest deductions. The new tax law places limitations on the amount of interest companies can deduct. If a company has annual revenue over $25 million, it may only deduct qualifying interest expenses up to 30% of adjusted taxable income. Adjusted taxable income is defined as taxable income less depreciation, amortization, interest expense, and interest income. This limited ability to deduct interest paid or accrued may have an impact you are considering, says Matthew Diener, CPA, a tax supervisor at NYBKW, a Melville, New York accounting firm. If a company finds itself in a situation where they are approaching this limit, leasing becomes a significantly more appealing way to acquire equipment since the entire lease payment is tax deductible and not subject to this limitation. Section 179. Under Section 179 of the tax code, companies that purchase qualifying equipment and put it into service can deduct the cost of the equipment immediately within certain thresholds. Traditionally, companies with up to $2 million in equipment investment could write off up to $500,000 in those purchases. After that, the deduction declined by $1 for every purchase dollar that exceeded the total investment allowance. The tax law changed the purchase threshold, bumping up the investment threshold to $2.5 million before the phase-out begins, and allowing companies to deduct up to $1 million of purchases up to that threshold if they have the taxable income to do so. The advent of bonus depreciation available to all companies for new and used equipment reduces the relevance of Section 179 since there is no longer a restriction on company size in order to fully expense an equipment acquisition in the year acquired. Green energy credits. As a result of the new tax law and the Bipartisan Budget Act of 2018, clean energy investment tax credits are extended and reinstated. Companies may qualify for a 30% credit for solar, fuel cell, and wind investments, as well as a 10% credit for geothermal, microturbine, and combined heat and power investments. Vehicle and fleet acquisition. Recently published IRS guidance clarified depreciation limits for passenger vehicles. Companies that put vehicles in service in 2018 and don't claim bonus depreciation may deduct up to $10,000 for the first year, $16,000 for the second year, $9,600 for the third year, and $5,760 for each later taxable year in the recovery period. If a taxpayer claims 100% bonus depreciation, the greatest allowable depreciation deduction is $18,000 for the first year, $16,000 for the second year, $9,600 for the third year, and $5,760 for each later taxable year in the recovery period. Leasing and financing decisions. Much of the industry is still wading through the changes and determining what they mean for customers and equipment leasing and finance providers. Tax reform dramatically changed the landscape for the equipment leasing and finance industry. Equipment finance companies are in the process of determining the full scope of these changes, but 100% expensing for 5 years, a lowering of the corporate tax rate, and a new limitation on the ability to deduct business interest all impact the industry in one way or another, says Ralph Petta, Equipment Leasing and Finance Association President and CEO. The new tax law holds potential benefits for companies, but also requires careful examination. Decisions about leasing versus other forms of financing equipment now demands more thorough examination of multiple factors such as taxable income levels, total interest expense, deduction thresholds, among others. In addition, state tax laws may differ from the federal law, which may add another layer of complexity. As the IRS guidance continues to release guidance regarding the new tax law, it is critical for companies to work with a skilled tax professional to ensure they're making the best decisions for their situations. Will the new tax law impact your equipment investments? SLS can help your company make the most of these new tax provisions by marrying them with competitive financing. Always consult your tax advisor for application to your specific situation and then give us a call. We can help. Visit us online at slsfinancial.com and we'll look forward to talking to you soon. Thank you very much and have a great day.